Good afternoon and welcome to another LBMA webinar. Today we are looking at another Asia update, and we are delighted to welcome back Sunil Kashyap, a Managing Director, Head of Commodities at Scotia Bank, and Jeremy East, our Senior Advisor for Asia. We also welcome two new faces to talk about this today. We've got Albert Cheng, CEO at SBMA, and Nicholas Frappell, the Global General Manager at ABC Bullion. So without further ado, I'm going to hand over to Jeremy. So Jeremy, whenever you are ready.
Thank you, Taylor. Today we're going to kind of really just do a quick update on 2020 and also maybe look forward to 2021 as to what we might be expecting in Asia, in China, and on Australasia as well. To kick us off, I thought I may start myself with a bit of a reprise of China. As we know, China over the past year has been really not buying any gold. The demand at the beginning of the year was there and the lead up to the Chinese New Year, and then obviously came the impact of COVID. And since then, there's basically been practically no imports of gold into China. In terms of the market, it's performed pretty well. The Shanghai Gold Exchange has had good volumes. There's been no disruption in terms of trading and settlements. However, as we know, with China, the country, it's not possible to export gold from China. So unlike other markets like Singapore and Hong Kong, where imports and exports are free, and China it's not. And so over the past 10 years, China has built up a significant stockpile of gold in the country, and there's no kind of pressure valve in the event that there's an excess of selling in the country. And so that gold then moves more towards a discount compared to the international price, which is something that we've never really seen before in the last 10 years. And gold traded down earlier this year to a discount of around $50, bearing in mind gold normally trades at a sort of $10 to $20 premium. Really sort of the demand in China it's been obviously impacted by COVID. The high prices have deterred buyers. Jewelry demand is down significantly. And also I think there's been a certain amount of sort of rainy day selling. But as we know, China over the last 10 years has been importing 1,000 tons of gold every year, and these significant stocks, it needs to be kind of consumed in the market, and I think that's what we've been going through over the past sort of few months. And as China now is starting to come out of the economic impact of COVID, and in fact China's economic statistics are fantastic. Over the last few weeks, we've just been seeing some amazing data coming out of China saying, demand is up, production is up. So I think we can start to see and expect to see China coming back as a force in the gold market. The demand seems to be picking up, and so the local discount is narrowing. It's last week it came into less than $15 compared to London, and we're seeing quite a dramatic strengthening in the RMB as the economy strengthens. So prices falling, international prices falling and making it more attractive to buy, stronger currency also making it more attractive to buy, and a booming, strong economy. I think indicating that for next year, we're going to see it's like a change in direction in terms of China. And I think we're going to see China coming back into the international markets, and maybe the flows that we haven't seen this year will start to be picking up again next year. So
Jeremy, sorry, yeah. Jeremy, sorry to interrupt you, but I just wanted to ask you, there's been some news from China about the big Chinese banks closing down or stopping the opening of retail accounts for trading on the SGE. What do you make of that news, and what do you think the impact will be?
I personally think, you know, I think if we take a look back to when the oil price went to a discount, there were a number of products that were being sold by Chinese banks to retail investors, which led to significant losses for those retail investors. And you know, who would have thought, you know, oil would go to a negative price? And unfortunately, those retail investors in those products, you know, it costs a significant amount of money, and you know, and obviously it raised the question about regulation and appropriateness of investments. And obviously this year, gold, I'm not saying that gold could go to a negative price, but I'd say that I'm sure it's being, the regulators are being conservative in terms of the products that are available to the retail investor, making sure it's appropriate for them. Gold, volatility, you know, we're seeing gold in the last few weeks has moved down from over 2,000, and it broke down below 1,800 today, so a few days ago. So there's increased volatility in the market. So I think it's really just maybe a cautionary measure. I don't expect it to have a big impact onto the market. But I think it's something that, you know, it's really just kind of maybe learning the lessons from earlier in the year, that, you know, appropriate products for the category of investor.
Okay, thank you.
So let's move on to Nick. Nick Frappell is the global general manager of ABC in Australia. Nick, maybe you can start us off where, you know, what you've been seeing in terms of the flows, premiums of the market this year, and what you see for next year.
Thanks very much, Jeremy. Really, as you said, with the decline in the demand, really serious decline in demand from China and India, we've seen a largely quite sort of soft market for physical gold in the region. But that's been offset to some degree by really good demand from both ETFs and from the CME. So in terms of premium, the flows into the ETFs probably haven't really made any noticeable difference, because most of that involves flows to London as, you know, terminal market. However, then it's at about 900 or 1,000 tons of flow into that direction. So that was, you know, price supportive. The CME, however, was obviously rather more interesting in a way, because it arose out of, you know, fears of non-delivery or the inability of the physical market to get gold into CME depository locations. And if you look at the additional flows on top of the kind of general balance of gold that's held in those depositories, there's an additional 925 metric tons or so that flowed over to New York. And that actually did enable some refiners and some traders to pick up some good premium. So that was the good news story of gold premiums in a market that was otherwise probably pretty disappointing. And as you alluded to, the really high prices that arose obviously took a lot, induced a lot of secondary gold to hit the market. So that tended to be, you know, a bit of a weak picture. Gold has obviously dropped in price pretty significantly over the last 2 months, and particularly the last week. We've yet to see, we're certainly seeing some signs of new demand. It's not quite translating into significantly firmer premium despite the lower price. Looking forward to next year, we've obviously seen some really big one-off moves, well, what look like one-off moves in CME flows in terms of CME and ETF flows. So I think one of the themes you picked up on is, you know, move from, you know, east to west in terms of physical demand. Next year, we really want to see signs of the East, as it were, picking up again.
So this year, I think all the stars were aligned for gold from an investment perspective. How do you see next year coming? You know, we're going to see quite a change in terms of the big bull factors for the gold market for this year, but we're going to see some of the impact in next year in terms of potential inflation, US interest rates, and you know, the printing of money, the cash stimulus that's going on in the West.
Yeah, absolutely. I mean, I think that some of those really macro factors will remain in play. Looking at inflation first, Taylor, if you want to put up the 5-year forward slide at this point, if you just move on to the next slide. Thank you. If you look at US 5-year forward break-even inflation, it's moved slightly higher, but it's still roughly the level of, I think, August or September of last year. So my take is that so far inflation looks pretty muted. So I'm not sure yet if it's going to be a big feature in the bullish bullish backdrop. However, what I do expect, and I think this seems to be a dangerous consensus impression, is that interest rates and real interest rates will remain low through next year. And given that the Fed is now picking up on average inflation targeting, that actually allows them the scope for inflation to sort of just run a little bit. And that should, if anything, let real interest rates decline even further, weaken even further. That's a bullish outcome for gold, because gold always responds positively, or almost invariably responds positively, to lower real rates. The other factor is, you know, what's going to happen to the US dollar. It's right on critical support. You know, depending on which way you look at it, may have broken through critical support for the bull trend that's been in place since 2011. So there's a lot of commentators who expect the US dollar broadly to decline next year, partly on the back of, well, essentially on the back of twin deficits and the fiscal and monetary response to COVID. The only caveat around that is that President-elect Biden probably is a little bit constrained in terms of what he can do fiscally, because he's very unlikely to have control over both houses. And also there's a little bit of controversy at the moment around Steve Mnuchin sort of setting aside an extremely large portion of cash for the CARES Act that was earmarked for spending, or sort of a backstop for spending. It's about $455 billion US. That's a really substantial amount of potential ammunition fiscally and monetarily for the US economy. It seems to have been put in a place where it can only be released with congressional approval. We're seeing a lot of, obviously, coronavirus is rising pretty rapidly in the States. So if that impacts the US economy in a large way going into Q1 of next year, we might not see a really strong, or as strong a fiscal response. What we should see, I suppose, is the Fed stepping in even further. That to me implies the case for a bull market in gold next year is strong. So that covers, you know, inflation, US dollar interest rates, and the cash stimulus. If you look at where gold is now, and, you know, for a sort of a where are we now and where are we likely to go, Taylor, if you just want to pop onto the next slide. You know, gold has retraced 50% of the March, August upswing. I think it looks pretty horrible on one level, but if you look at it, you know, if you step back, that's not an unusual downswing for a market that's had a profoundly powerful up move. So this area around 1763, I'd say, is a good support level, macro support. I also think that the 38.2% retracement of the August 2018 to August 2020 up move, which comes in around about 1730. That's powerful. And interestingly, I've got a target there on one of the long-term charts that I use that's reasonably insightful. When those targets are met, and we'll look at that in a moment, when those targets are met, often the market expends energy to get there and then turns around and heads in the other direction. So I think we've got this area, and finally I'd just say around 1690. Now it's very obvious, none of these support levels, obviously some of them are fairly remote compared to where we are now, and they're big numbers, so they're not really very useful if you're sitting there thinking, you know, how about punting the market tomorrow? But if you're looking at a 2021 sort of view and where do we go from here, I think they're useful. Taylor, if you just want to go on to the final slide, the point and figure, you can see there's a target there. We're quite close to it actually on that chart, you know, 1725. And then you've got that fairly good uptrend line coming in. I think that's where you should see some decent support. And if you look at this chart, you know, for a moment, you can see that it was a pretty good guide to both the high when gold, you know, the last high when the gold went to 1921 or 22. It was a few percent above that, the top final target. And then it called the lows pretty well with the targets down to 1059. And of course, the recent high at 2074 indicated there was going to be a local top at about 2084. Not bad, $10 away. So this is quite a nice, to me, not a bad way of looking at how the price action might unfold. Hopefully we won't trouble that 1530 level, which is also staring at me. But, you know, hopefully, Jeremy, that gives you a sense of where I think the macro supports for the market are, and where we, you know, where we should find support, and then perhaps the chance for the market to regain strength.
So basically you're saying that there should be support just around here and slightly below here.
Yeah, that's right. That's right. And I know it's a big margin, or it's a big buffer area that I've chosen. But that's in the context of saying, you know, if you're looking at what we've done in the last 2 years, really, since August 2018, and that move away from the recent high, and then trying to get a sense of how the market would cycle through from the close of 2020 on through 2021. That's how we'd see it. And I think the most important thing is, so far, the really fundamental drivers for gold, which is the potential for a weakening dollar and weak real interest rates, they remain in place.
Right. Thanks, Nick. Let's now turn over to Albert, chairman of the SBMA. Albert, we've been obviously hearing about the flows of gold from the east to the west, which was, you know, a turnaround this year from previous years. Maybe you can give us a short overview of the Asian market, you know, highlighting other areas which we don't really hear very much about, countries like Vietnam, Thailand, and Indonesia.
Certainly, yes, Jeremy. I think we have seen a temporary more gold moving from the east back to the west, but I don't think in the long run the mega trend of gold moving to the east will change. But let me give you a little bit of overview of what we have seen in the region, started with Singapore. Now, Singapore being the hub for the ASEAN market, the domestic market is always very small. But we do see retail physical gold investment in Singapore has in this year is quite robust. We've seen both way activity. The buying community was excited with a small bull market in Q1 and Q2, while physical holder, including those scrap jewelry, were taking profit in Q3, which spiked when price spiked over $2,000. But the Q4 retreat, now below 1,800 level, has seen renewed interest and buying interest from the group that think that they may have missed the first run up and was waiting for this retrenchment to catch hopefully a potential larger bull market. Jewelry sector badly hit in Q1 and Q2, but fortunately Singapore recovered quite well in Q3 and we have seen business coming back. And looking into Q4, we have now actually 0 cases most days and maybe 1 case here and there. So actually the business activity is back to normal. Hopefully the industry is thinking that by the end of this year, we probably will be like last year, but if worse, it may be 10 to 20% less than last year in terms of jewelry. Looking ahead in 2021 from the Singapore perspective, it probably will be sideways range trading market and for another 6 to 9 months, and to digest this oversupply which we have seen over the year. Turning to Vietnam, jewelry consumption was badly hit, and I saw some figure like 40% down, particularly in Q2. Fortunately, Vietnam has actually also controlled the pandemic quite well. Q3 activity resumed, and then they are looking at Q4 is going to be a good quarter. So perhaps if there is any decrease in jewelry consumption in Vietnam, it might be just a small figures. In terms of retail investment, we see this holding very much in Vietnam. It's basically profit taking, and it probably in the form of very chunky jewelry export, which probably we have seen it from refinery in the region. And premium in Vietnam was as high as, or even up to now, is $110 per ounce. It's quite significant. Overall, I think for the first 9 months, counting both jewelry and retail investment, it was down by 1/3, about 33%. But when we talk to the trade in Vietnam, they all expect next year is going to be a good year. I mean, we also know that if there is any changes in the regional business flow, some of the down in China or in the region will be actually beneficial to Vietnam, and that has an impact to jewelry consumption. If we now turn to Thailand, again, jewelry consumption was down significantly, even worse than Vietnam. We've seen about 50% down in Thailand. And in terms of retail investment, bar and all these things, we all know that the bar holder in Thailand keep the bar until they realize gain. So I think the price hike to $2,000 is a good time for them to dishold. So we have seen quite a significant amount of gold coming out from Thailand, even though during the pandemic, I think a refinery or the regional player has been very busy trying to ship those scrap jewelry either into Singapore refinery or to Switzerland. And if I look at the statistic that has been recorded in Thailand, during the first 10 months, jewelry export from Thailand amounted to almost 200 over tons of gold coming out from Thailand. But on the demand side, they still have 100 over tons of demand. So the net probably is about 70,000-80,000 tons of net export, but there were actually import. And in terms of Indonesia, I would like to point out that jewelry consumption also badly hit. I mean, you will know that in whole of ASEAN or Southeast Asia, Indonesia is badly hit, and the pandemic was widespread. Jakarta is very badly hit, and hence jewelry consumption was down by almost 50%. And we also interviewed some jewelry manufacturer, and in terms of fabrication, because of the disruption in flight, jewelry export is actually come almost to very low number. And with the gold price now at this level, Indonesian consumer cannot afford the more higher carat. When they are not like China buying 24 carat or even 22. They now even go down from even less than 14K. Some of the jewelry in Indonesia come down to even 9K. It reflects that the price of gold was high, rupee was devalued, but buying gold jewelry is still something that a lot of rural folks like to continue to buy. So that is the trend. In terms of retail investment, bar consumption is double-digit growth. I mean, it's the traditional wisdom of buying gold as store of wealth, and if there is a trouble, if you still have some cash, buy gold. So gold bar consumption is double-digit, but it's not big double-digit. It's probably 15-20%. It's not huge number of increase. So these are overall Southeast Asian pictures.
Do you have any potential updates for us on Japan?
I do. Actually, I also, because of my relationship with the Japanese trader, and I spoke with some of them recently. Well, I mean, price of gold in yen term reached all-time high, 7,000 yen per gram. I think it never had been before. Huge individual selling. I think it's probably from the old folks who has accumulated gold long time ago, at their 50, in the 60. In 1970 and 80, we saw a lot of Japanese high net worth people buy gold, and they kept under the mattress. And now is the time for them to realize it. I mean, it's good price, and also they can recover the consumption tax. When they bought was 3%, now it's 10%. So it's double whammy to them. It's actually double gain for them. But we also saw that this hoarding was absorbed by the younger people. I mean, the Japanese actually is looking gold as an asset class now. I mean, I think thanks to a lot of our friends are doing education in Japan, that I think even younger people now look at having some gold in their portfolio is not a bad thing. So this hoarding actually is being absorbed by the younger people. But again, we also know that because of the consumption tax issue, that there's a lot of smuggling into Japan. I mean, with the disruption in fight, naturally, I think it's much less. But yet, I think there are still some of the smuggled gold come through the porous border. So this is still an issue in Japan. Some news about Japan. Tocom no longer has a Tocom future contract. It all moved to Osaka Exchange. So you are now, if in Japan, you have to trade future at Osaka Exchange. And they were saying that the Tokyo Financial Exchange, a new exchange, is going to have gold ETF margin trading contract. So these are new things happening there. And we don't hear too much about Japan, but it is one of the biggest market maybe 20, 30 years ago. I think this I think we should all continue to engage the Japanese market. Thank you, Jeremy.
Thank you, Albert. It's really interesting, that they're starting up ETF contracts. We've seen a couple of companies in China launch some ETFs, and because ultimately the big driver this year has been the investors and the ETF. And,
I think going forward, institutional investor is something that we all need to look seriously on.
Yeah. Again, we don't really see the same size out in Asia. Compared to
China has about 60, 70 tons of ETF. I mean, it's not big, but it's coming along.
Okay, thanks, Albert. And finally, let's talk with Sunil. Sunil, we've heard from Albert, record high prices for gold, and I'm sure it was the same in India. How do you see this year, the domestic market, and for next year, any potential changes compared to what we've been seeing?
Sure. I think, just the same trend in terms of pricing. For the first time ever, gold in rupee terms hit 50,000 rupees per 10 grams, which is the price that's denominated. To give you an idea, it used to be probably 35,000 just about a year ago. So I think the Indian public definitely saw some amount of sticker shock as far as prices is concerned, and overall demand was lower. It's also fascinating that normally when demand is less, the discounts in the local market go down to, let's say, $5, maybe sometimes $10 an ounce. But this time around, we saw discounts of as high as $50 an ounce. So much like China and the Shanghai Exchange, India also was at huge discounts. And I think it was partly because of price, but predominantly because of the pandemic. India was very badly hit because of the pandemic. And the biggest factor was really before the pandemic actually could make an impact, the government entered into a big lockdown, and it was a severe lockdown where they just shut everything down. And the impact of that was that a lot of the migrant workers who are working in the construction industry or even in factories, etc., all of them went back to their home cities. They were unemployed, and that factored into a lack of disposable income, and also ultimately into lower demand from this very strong sort of demand sector. So that because of that, this sector actually, instead of buying gold, they ended up actually selling gold to try and raise cash to take care of their families because they were unemployed. Things have turned around. The economy is started turning around now. The latest GDP numbers saw a sharp uptick. We haven't recovered all the growth that was lost, of course, but the trend is positive, and we started to see lower discounts. In fact, a few weeks ago, we actually saw premiums and imports had started again for some short period of time. So the trend has changed around, but the first half of the year was not very pretty. Mute.
Okay. One thing we've heard about is that people, instead of actually just selling their gold, they've been pledging their gold. So sort of like a gold loan against cash, and it's become a kind of a huge industry. Can you tell us something about that?
Yeah, so it's like I said, because of the lockdown, a lot of people didn't have regular income, and so they still believed in gold. They didn't want to sell the gold outright. So there is a product, it's called gold loans, retail gold loans, but actually it's basically a rupee loan against gold collateral. And so a lot of people had used that option. There's 3 or 4 finance companies who specialize in giving these loans, and they can turn around a loan in about 5 minutes. So you go there with the jewelry, pledge it, and you take your cash and go away. And month later, 2 months later, when you have the cash flow back, you can give the cash back and take the gold jewelry back. So I think that particular product was extremely popular. There's a lot of domestic banks now who've started marketing that product also, and you're seeing more people opted for it. The overall outstandings, if I'm not mistaken, it's something close to about 400 or 500 tons of gold has been pledged. Wow. To borrow against. So it's a significant amount, and I think that's again driven by the fact that there was a shortage of cash flows. On the other hand, the interesting thing that's also happened is because of the lockdown, because shops were closed, the demand side has also seen a change. Typically demand in terms of Indian gold demand translated into people buying gold coins, jewelry, or gold bars. And since the stores were closed, what we have seen is an uptick in terms of people either buying gold in the form of savings plans that exist, some mobile-driven apps which allow you to buy as less as 0.01 grams. And so a lot of people, especially younger folks, have been investing in gold using these apps. There's 2 or 3 of them who have become quite popular. And so these, the youngsters would buy maybe $100 worth of gold or $10 worth of gold at a clip. So you've seen a sudden uptick in that activity. And also in terms of some of the most sophisticated investors, you've seen more buying in the ETFs. The ETFs had been declining in the local market there. We've got about 6 or 7 active gold ETFs. And in the last few months, you've seen actually the investment go up in those ETFs. And also the government a few years ago brought out a product called a gold sovereign bond, whereby investors could buy gold in paper form, pay rupees, and then get a certificate which entitles them to get back gold 3 years or 5 years or 7 years hence from the government. And the recent tranches of those bond issuances have actually seen records in June, July, August. Each of those tranches saw investments of between 700 kilos to, I think, as high as 2 tons in some cases. So there has been renewed interest in terms of buying gold in different forms rather than physical.
That's really interesting. You know, on the webinars that on the LBMA we've seen over the last sort of couple of months, we've seen some sort of presentations from some of the sort of digital token, all the rest of it, really. But I just have the feeling that, you know, this could be a product that would be very attractive sort of out here. You know, I think it's people in Asia have got an affinity for gold. And the COVID really kind of restricted their ability to go out and buy gold. And I think there's you know, the idea like you just described of seeing in India, people buying gold using their mobile phones, you know, tokenized gold. You know, this is maybe the start of the turning in the market. So, and it's a huge market out here, you know. So
one more thing, Jeremy, I think, you know, in terms of just some of the people watching the webinar should be aware of, one of the major trends expected in 2021 in India is the emergence of the International Bullion Exchange. You know, the government has reformed its policies to facilitate the launch of a physical spot exchange. And it's called the International Bullion Exchange, IBE. There are some processes going on right now to put in place the regulatory framework to run that exchange. And I think probably in the first half of 2021, we should see the launch of that. And that exchange would be set up in a free zone, which will allow overseas players to also come in and participate in the Indian market. That should be quite an interesting, exciting event.
It takes us back to the launch of the Shanghai Gold Exchange, where we were international advisors back in 2003. So it's great to see that you know, an exchange is happening in India, and I think you know, from an Indian perspective, they've got, you know, the interest in the market, they've got the infrastructure is there, all the vaulting facilities in all the different countries. So you know, the thing that was missing was an exchange, you know, providing transparency of pricing and everything. So I think that's great. Well, so, from a
question to you, I heard that the gold loan in India, the way that you describe, how much is the quantum per transaction?
Oh, the transaction could be as less as 10 grams. So 10 grams is about worth 50,000 rupees. So you could borrow, let's say 20,000, which is 25,000, let's say, which is $500. So, you know, you could go down to $300 to $500 per loan.
And then the bank is acting like a pawn shop, that you pawn the jewelry to them, and then at some time back you then collect the jewelry and pay the interest, right? Yeah.
So that's what's happened is that the government, I mean, this particular product is regulated, so that's why you know, RBI keeps control on it, and so these guys are regulated. But effectively, a lot of these finance companies act as pawn shops because their main product is only this. But it's much more professional. They have, you know, maybe 1,000, 2,000 outlets. They have a very sophisticated system of MIS and monitoring credit, etc.
Yeah, but how are they going to ascertain that the gold is a piece of genuine piece and not a fake one?
So they have acquired expertise. So, you know, people have been trained up. So they normally get somebody from the jewelry sector to be sitting at their offices, and he's responsible to assay it. I think all in all, they haven't had too much problems, and technology now with XRF, etc., allows you to get a little bit of accuracy. Remember, there's quite a margin. I mean, they lend only 75% of the value of the gold.
Yeah,
So,
yeah. All right, thank you.
Great, thank you. Let me pass back to Taylor.
Thank you very much, gentlemen, for contributing to this webinar. We hope that all our attendees were able to learn a lot from this. However, if you still have any questions, please email us at ask@lbma.org.uk, and we will contact you and endeavour to answer you as best we can. And so with that, I do wrap up this webinar. I will let you know that upcoming, we do have our final webinar for the year, which is on TMO and Brexit. And we have Rachel Steerat from Her Majesty's Treasury, we have Andrew Tucker from HMRC, and we have Stuart Martin from Deloitte. So we do hope you can join us at 12 o'clock on Thursday next week for our final one, before we take a large break for the winter. We will be returning with a trade data webinar in the middle of January. So that is it from me. And once again, I'd like to thank Nicholas, Sunil, Jeremy, and Albert for joining us. And we hope you have a lovely weekend. So thank you, gentlemen.
Thank you.
Thank you.
Thank you.